To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So friends, we have discussed about futures. We have seen how future prices are computed, how forward prices are computed. We have seen how stock futures can be used, or how index futures can be used to hedge stock positions. We have done a lot of problems. The next section that we have is a wonderful section in derivatives, which is called options. This is the most interesting part of your derivatives and analysis chapter, simply because one, it is very novel. Novel means new. It is when I say new, it is something new for you as a student. You would never have heard of this kind of stuff. Second thing, it is very logical and very slight bit of mathematics. It is just plus and minus mathematics only, nothing fancy. At a later stage, we will discuss about Black-Scholes model, where you have to use some formula and all, but that is aside. Fundamentally, this particular topic is more about logic. If you understand the logic, you have completely understood this chapter. You have to keep your eyes and ears open and you have to think logically. That is something that I want all of you to do in this chapter, because just like future prices are spot plus interest, option prices also have some similar working. Okay, what did we discuss? Future or forward prices? Spot plus interest. If there is any dividend, then spot plus interest minus dividend. Very, very simple computation for future. So, same way, option price also have a very, very simple formula, or rather a very simple working when you approach it logically. Now, in addition to the fact that what is given in our material with respect to options, we will also discuss about few kinds of structures of options. What are the various strategies that can be used in by using various kinds of options, and all of that. We will discuss all of that in course of this particular topic. So, if you remember, when I started this chapter, derivative valuation and analysis, I explained to you what is a forward contract, what is a future contract, and what is an option contract. Some of you may be remembering it, some of you may have forgotten it. Okay, so let me just recap. So earlier, when I was trying to explain to you guys about futures and options or forward contracts, I took very simplistic example. If I am not wrong, I took an example of a brinjal, I took some jewelry, I took some gold. Okay, now that we have understood what a future contract is, forward contract is, now let me take more, what can I say, more capital market oriented examples. That is more securities related example. That is more share prices, index, or currency, or commodity. We can take examples like that, because that is what will help you understand it better. So, more than a brinjal example or a gold example, a stock price example is far more relevant in your case. Okay, so now let's start off. What exactly is an option? Option is basically a right. That is what we discussed. Option is a right. Okay. The person who is buying an option is buying a right. Okay. Person who is selling an option is selling a right. Right. A person who is buying an option is buying a right. Buying a right to do what? Buying a right to buy something. So, let us take example of shares of Reliance Industries Limited. Let us say today the share price of Reliance is 2000 rupees. If I am buying an option on Reliance, okay, if I am buying an option on Reliance, let's say I am buying a call option on Reliance. If I am buying a call option on Reliance, then it means I am buying a right to buy the shares of Reliance. If I am buying a put option on Reliance, it means I am buying a right to sell the shares of Reliance. See the words that I have used. Call and put. Call means I have a right to buy. Put means I have a right to sell. Okay. So, when I am buying a call option on Reliance, I am buying an option, or I have a right to buy shares of Reliance. When I am buying a put option on Reliance, I am buying a right to sell shares of Reliance. Okay. Call means buy, put means sell. This is something that you have to remember. The way I used to remember is C, B, P, S. C and B are together. P and S are together. So, C comes after B, right? A, B, C. So, C comes after B. So, hence C and B are together. P, Q, R, S. P and S come together. So, put means sell. That is how I used to remember in the initial days. Now, by default I remember it, but when I was studying, that is how I used to remember. B, C together, P, S together. Call means buy, put means sell. Okay. That part, if you have understood, first step we have crossed. In an option, a call option buyer has a right to buy, a put option buyer has a right to sell. Okay, first part clear? Now coming to the second part. By what? We said Reliance shares. Reliance shares today are 2000 rupees. If you are buying a call option, you have a right to buy the shares of Reliance at a future date. So, derivatives, my dear friends, remember, are all transactions with respect to future dates. You are entering into contracts where you are agreeing to do something at a future date. In case of futures and forwards, it was you are agreeing to buy or sell. That is, if you are a long future or a long forward, you are agreeing to buy. If you are a short future or short forward, you are agreeing to sell. In case of a call option, if you are buying a call option on shares of Reliance and say today the share price of Reliance is 2000 rupees, you are agreeing to buy this share of Reliance of whatever is today's price is 2000 at some other price. It can be 2000 also, it can be 2100, 2200, 3000, 4000, or it can be 1900, 1800, 1700, 1600. It can be across the entire spectrum. 2000 is the today's price. You are agreeing to buy shares of Reliance at a future date at a price anywhere ranging from 0 to infinity. But usually you will not get 0 or infinity, you will get in and around 2000, because what happens is people would like to take decisions which are closer to what they can perceive today. Let's say today you know that the price is 2000, after 1 month it may be 2100 or 1900 unless some catastrophe happens, right. So, you will see prices very close to the current spot price, that is you will see prices close to the current spot price. However, when will you see prices close to the current spot price? When the contracts are also close to today, that is you have a 1 month contract. What do I mean by 1 month contract? When I said that you are buying a call option, it means you are buying a right to buy the shares of Reliance at a future date. What future date? So, usually future date here refers to 1 month, 2 months or 3 months. It can be 4 months, 6 months, 10 months also, but usually the dates are very close to the current date. You will have near month option, that is current month. You have far month option, that is 3 months down the line. You have mid month option, that is middle of the month. So, let us say we are in January. On 1st of January, usually on exchange, you will see 3 options. One for the last Thursday of Jan, one for last Thursday of February, one for last Thursday of March. This is in the Indian context. So, when you are entering into a buy-call contract on shares of Reliance, whose current price is 2000 rupees, you are agreeing to buy the shares of Reliance at a future date, okay, agreeing to buy at your choice, again, at your choice. In case of a forward and future contract, you are 100% going to buy. In case of a call, you have a choice, okay, that is the word that you have to remember, you have a choice. You have a choice to buy the shares of Reliance at a future date. It could be, since you are in January, it could be Jan and also February and also March and also. At what price? Today's price is 2000. It could be 2100, 200, 300, 400, or it can be 1900, 1800, 1700, and I said it is the entire spectrum of 0 to infinity. But usually it is closer to the current value, current price. Current price is called as spot price. So, the prices at which the contract is entered, that is this 2100, 200, 300, 400, 500, these are called strike prices. These are called strike prices, and current market price is called spot price, right. This could be called strike prices or even called exercise price. The current market price is called spot price or current price or market price, any of those terminologies mean the same, okay. So, now let us understand this contract again. You have purchased a call on Reliance whose current market price is 2000 rupees. You have purchased a call option with 3 months maturity, okay, at 2100. That is, after 3 months, you have a right to buy Reliance shares at 2100, no matter what the market price at that point of time is. That is, after 3 months, the price may be 5000 also, the price may be 0 also. You will have a right to buy at 2100. You got this point? And for this right, you have a right to buy. When you have a right to buy, there should be somebody else to sell, no? So, when you are entering into this contract in a stock exchange, you go to the exchange and you make a statement. So, I am making it simplistic, okay? You make a statement, I want to buy Reliance shares 3 months down the line at 2100 rupees. Will anyone give me a contract, a call option for this? So, the other party will say, okay, I will sell a call to you. You want to buy this call, you want a call option. So, I will sell you the option, give me 100 rupees. that 100 rupees what you are supposed to give is called as a premium. 100 rupees what you are supposed to give is called premium. So, you have a right to buy shares of Reliance at 2100 rupees 3 months down the line, whose current spot is 2000, and this particular right to buy, you have purchased this right by paying a premium of 100 rupees. You are called as a buyer of the call. The person who is other party to the contract, who is agreeing to sell to you Reliance at 2100 after 3 months, by taking rupees 100, is called as a seller of the call option. You are the buyer, he is the seller, he or she, okay. You are a buyer, he or she is the seller. So, in a call option, the buyer has a right to buy. Now, what are the words that we have learnt in this? Call, option, right to buy. Then we have heard spot price, then we have heard exercise price, then we have heard premium, then we have heard the maturity period, that is the duration of that particular contract. So, these are the 8 terms that we have learnt. Okay. Now, given this particular set of information, now let us try and understand what actually happens. Okay, let us assume that you enter into the same contract. You paid 100 rupees, now you have a right to buy. You have a right to buy shares of Reliance after 3 months at 2100. On the 90th day, that is after 3 months, let us say Reliance share price is 3000 rupees. I am purposely taking extreme examples, okay. Let us say after 3 months the price of share is 3000. What will you do with your right? You have a right to buy at 2100. Market price is 3000. Yeah, you have made money. How? You will buy from this particular poor, call seller, whoever has sold you that right, at 2100. And then you will sell in the market at 3000. You have made 900 rupees profit. Initially, you have paid 100 rupees premium. So, 900 minus 100, 800 rupees is the profit. Correct? So, when you buy a right to buy a share of a particular company or a stock at a future date, and if the price goes up, when you have a call option, when you are long on a call option and the price goes up, then you make money. Let us say ulta happens. From 2000 rupees, let us say Reliance falls to 100 rupees. What happens here? You have a right to buy at 2100. You have a right. What is the difference? Key words that I have been telling right from the beginning. Right. Why am I saying right so many times? Because it is your choice. In a forward contract or a future contract, you are an obligation. You are obliged. That is, you have to compulsorily, mandatorily honor the contract. Here, you have a choice. You may buy, may not buy. Reliance came down to 100 rupees. Okay, you have a right to buy at 2100. Will you exercise the right or will you keep quiet? Of course, why will you buy something at 2100 when it is available at 100? You will say, forget this particular contract, to hell with this contract. I have paid 100 rupees, chalo, let me lose the 100 rupees. I don't care about the 100 rupees, so I have lost only 100. But what happened? When the price fell from 2100 or 2000, whatever was the spot, when it fell from 2000 to 100 rupees, basically you have ensured that you did not buy it at a future date at a high price. You are not obliged to buy at all because you have not entered into a forward contract. You have an option. You have a right. So, because of that, what has happened? You have saved yourself. So, if the price goes up, you exercise the right, you make money. If the price comes down, you don't exercise the contract, you lose the premium what you have paid. Okay, this is very simplistically a buy call. Correct? In this, just like when I have explained to you right now what a buy call or what a call option is and how a buy call works, the other side also understands all of this. That is, the person from whom you are buying the call also knows this whole story. You are not just only the smart guy who is studying SFM in CA, right? There are so many other people who have studied. So, when they particularly enter into contracts, what will they do? They will also think through, so there is a risk. Okay, so when I am agreeing to enter into this contract, there is a risk that if the price goes up, I may lose money. So, the premium that I charge should cover for that risk. The premium of 100 rupees, what we were discussing, that should cover for the risk. And the way it covers for the risk, we will discuss. We will have a detailed discussion on how that 100 rupees is arrived, what should the pricing of an option be. That premium, whatever we are calling 100 rupees, right, is called as the price of the option. How should that be priced? What are the various factors that go into it? How does it get determined? How does it change? All of that we'll discuss. But for the moment, understand that the other party is also as smart as you. Even for a moment, assume that they are not as smart as you. What happens in a stock exchange is there are a lot of buyers, there are a lot of sellers. So, when you have a market which has a lot of buyers, lot of sellers, what happens? Please remember your economics. It is more close to perfect competition. In perfect competition, what happens? Everyone has information. There is price discovery is very, transparent, and the transactions happen at the market price. So, unless you know some information which is inside information, you cannot make great money. If everyone knows the same set of information, the prices are quoted in the exchange, you are just a taker of the price. Whatever price is quoted on the exchange, you will take that price. What do I mean by that? All of you know the stock prices, right? In every day in CNBC TV 18, in newspaper, bunch of other places, stock prices get quoted. In those prices, you may think that the price is high or cheap, but eventually when you go to the market, when you have to execute a transaction, more often than not, when you have to execute the transaction, if you want to buy something, somebody should be willing to sell to you at a price. If you hold on to your price saying, let's say the market price is 2000, I want it at 1990. Let's say the market price is not 1990, nobody is willing to sell to you at 1990. What will you do? They all say, we will sell to you at only 2010. You'll wait for the whole day, next day also you'll wait, third day also you'll wait. After that, what will you do? At some point, you'll make a decision. No, 1990 versus 2010, hardly 20 rupees, let me buy at 2010. Basically, in a large market where there are a lot of buyers and sellers, market determines the price and you basically take the price. Unless you do a huge volume and there is somebody else on the other side who is also doing a huge volume and both of you have opposite views, in which case you can move the price. Otherwise, typically for small volumes that we all do, we are all price takers. Okay, anyway, that is a separate discussion. But first, you have understood what is a call option. When you buy a call option, what happens you have understood? Now, let us move to the other aspects of this options. I have just explained to you what is a call option, but I want to, before I get into details of what is a buy call, what is a sell call, what is a buy put, what is a sell put, we will discuss all of that. But I want you to understand other elements around these options. Okay, unless you understand what this call option is, you will not understand these other elements, or rather there is no fun in learning, these other elements or other aspects of options without understanding what basically a buy call is. Okay, so now let us look at these other aspects. In addition to those 8 and 9 terms what we learned earlier, what are the other key aspects or factors related to options? One, we said there are two parties, so that is absolutely clear. For any contract, you need a minimum of two parties. It can be more than two, but in this case, you need two parties. One, basically, if it is a call option or a put option, whatever the option is, one person who is buying that option and one person who is selling that option. So, okay, that is first. Then there is something called as premium. The premium has to be paid by the buyer to the seller. Then options can be for what all scenarios. You can have it for real life also. In fact, there is an entire theory called real options. But if you look at it from perspective of our financial system, options can be for stocks, individual stocks, option can be for indices, options can be for currencies, options can be for commodities. So, basically options can be also found for interest rates. You have every single financial security or an instrument, you can create an option. And as I said, you can have real options also. What are real options is not covered in our syllabus, but it is a, you can just search about it and Google it, you will find out. It's a very interesting thing, right? So, options can be for all these various kinds of financial products. Now, there is one more important aspect that we all have to understand when we are talking about options. There are two types of options. I have told you call option and put option. Call you can buy or sell, put you can buy and sell. Even in this, there is another subcategory. What is this subcategory? An option can be an American option or European option. Now, what is this American European? It is nothing very simple. For a buy call, what did we say? If you are buying a call, you have a right to buy the shares of particular, let's say in our case Reliance, at a future date at a specified price for which you will pay a premium. Now, if this were an American option, you can buy any time during the 3 months. That is, you can buy any time during the 3 months. Whereas if it is a European option, you can buy only on the maturity date or exercise date. Listen to this again carefully. Same Reliance 2000 rupees, current market price, you have a buy call. You have a right to buy shares of Reliance of 2000 rupees, which are 2000 rupees today. The call is for 2100. So 2100 call you have purchased by paying a premium of 100 rupees. You have a right to buy the shares of Reliance after 3 months at 2100. It can be 2 months also, it can be 1 month also. We have 3 kinds of option contracts: near month, mid month, far month. In our case, we are taking the example of far month. In this far month contract of Reliance, if this option is an American option, any time from day 0 to day 90, assume that 3 months has 90 days, any day from day 0 to day 90, you can exercise. What do you mean by exercise? Exercise means you can go to the seller and say, boss, give me the share, I am willing to give you 2100. Exercising is honoring the contract and doing your part of the contract and asking for whatever is expected in return as part of the contract. You can do that any time during the 90 days if it is an American option. If it is a European option, you cannot do whenever you want. You have to do only on the maturity date, that is 90th day, or if this is a 3-month contract, the last Thursday of the 3rd month. Understood? American option is exercisable anytime. European option is exercisable only at a specified time. So, in Indian context, most of the options are actually European options only. Whatever are the index options that are traded, whatever the currency options that are traded, mostly European options only. In some cases, some American options are available, but there is far and few between. American options generally do not tend to have high liquidity, and they also have this issue of pricing. European options are slightly easier to price. American options are actually slightly difficult to price. Why? Because it can be exercised anytime. You don't have a specific period or specific date on which they can be exercised. They can be exercised anytime before maturity. That is why American options are slightly difficult to price. In Indian context, most of the options that are traded in the market are in reality European options only. Okay, so this is one part of the story where we are talking about the various facets of options. Now, we have understood about buy call. I will now explain to you all the other aspects. Buy call, sell call. Buy put, sell put. We will discuss these 4 aspects: buy call, buy put, sell put, and we will understand the payoff matrix. What is payoff matrix? Again, another new term. It is nothing fancy. It is a very, very simple word. Basically, at what points, what is your profit or loss? That is, what is your payoff at different prices of the stock price, underlying stock price. If Reliance moves from 2000 to 2100, what happens in buy call? What happens in sell call? What happens in buy put? What happens in sell put? So, we will try to understand at various prices of Reliance from 2000 to 2100, 200, 300, 2000 to 1900, 1800, 1700. What is going to happen in each of these scenarios? Buy call, buy put, sell put. And we will understand all of this after we have understood what is a sell call, what is a buy put, what is a sell put. Because we have already discussed what is a buy call. We have discussed buy call, right? Buy call about Reliance we have discussed. We will now discuss sell call, buy put, sell put. We will first discuss these 3 and then we will go into that payoff matrix or payoff chart or payoff diagram, whatever you can call it. We will go into that. Now, we will take the same Reliance example. I will not change this example throughout. Okay, when it is buy call, buy put, sell put, I will not change the example. You can use the same data points and try and see how the profits or losses look. In case of buy call, we took Reliance, spot at 2000, 3 months contract where the exercise price or strike price is 2100. We said the premium is 100 rupees, the tenure of the contract is 3 months, and when it is a buy call, you have a right to buy the shares of Reliance which is currently trading at 2000 rupees. You have a right to buy the shares of Reliance at 2100 3 months down the line by paying 100 rupees premium to somebody. Okay, this is the buy call. Now, invert the position. You are the seller. How will your payoff look? That is, if the stock price is 2000 rupees, you have sold a call option to one gentleman. Okay, you have sold a call option to one gentleman and you have taken 100 rupees, the call option has an exercise price or strike price of 2100, current market price of Reliance is 2000, what will happen? What will happen? When you are looking at price of, let us say, Reliance, which is currently at 2000 and price goes up to 2100, what will this gentleman do? Currently price is 2000, price has gone up to 2100. He has already purchased an option from you to buy at 2100. What will he do? At that point, he will not do anything. Price goes up to 2200. He will be very happy. I am going to get something at 2100, but actually I can sell it in the market at 2200. My profit is 100, but he's already paid you premium for 100 rupees. So that 100, initially whatever is paid versus the profit he makes, both get knocked off. So at 2200, he breaks even. 2300, he makes 100 rupees profit. So if the price goes from 2000 today to 2500 on the maturity date, 3 months down the line, he has a right to buy from you at 2100. Market price is 2500. You have made a loss. How much loss? You have to buy in the market at 2500, sell it to him at 2100. He will buy it from you at 2100, sell it off in the market at 2500. He has made 400 profit, you have made 400 loss. And this loss will be adjusted by the premium. So you got premium of 100 initially. So 400 minus 100. So your net loss is 300. His net gain is 400. He has made the gain minus 100 rupees premium that he is paid. So his net gain is 300. So the seller's profits or losses are mirror images of the buyer's profits or losses. If this gentleman or lady makes a profit, this person makes a loss. If this person makes a loss, this person makes a profit. So the entire profits or losses of each other are money moving from one person to another person. If I make a loss, you make a profit. You make a loss, I make a profit. Exactly like that. Understood this part? If you have not understood this, let us draw some diagrams and you will definitely understand it. Okay? Let us draw some very simple diagrams. Same example, we will draw some charts. Okay? Now let us take the case of buy call. Original example, you are the buyer of the call option. There is somebody called seller. You are buying from the seller. 2000 rupees is the current price. 2100 is the exercise price or strike price 3 months down the line. And the premium for this is 100 rupees. Agreed? Now, when the share price of Reliance is, let us say, exactly 2000. The share price of Reliance is exactly 2000. It is 2000 today. After 3 months also, it is same 2000. On the last day, last minute of that particular Thursday, it is same 2000. What will you do? You have a right to buy at 2100. Market mate is available at 2000. Will you buy or will you not buy? You will not buy. So, at 2000, you will not buy. Let us say the price in the market is exactly 2100. You buy or not buy? Market price is same, your contract price is same. Then also doesn't matter. You will not buy. Let us say it is 1900. That is, today's price is 2000, but on 90th day, the price is 1900. You have a right to buy at 2100. What will you do? Will you buy in the market at 1900 or will you buy from this gentleman at 2100? You will say, I will buy from the market at 1900. So, what will you do with this particular option? You will say, this option is useless for me. So, okay, 1800. Market mate is available at 1800. Why will I do anything with this option? Option is useless for me. So, 1700, 1600 like that. At every point below 2100, it is useless for you. If it is 2200, on the last day, let us say price is 2200. You purchase from this gentleman at 2100, sell in the market at 2200, you make 100 rupees profit. Initially, you paid 100 rupees premium. So, the net difference between this 100 profit and 100 premium is 0. So, in all the earlier cases, 1700, 1800, 1900, 2000, 2100 also, you didn't do anything. But at 2200, you said, I will exercise. So, in all these cases, 1800 to 2100, 1800 to 2100, you initially paid 100 rupees, you lost that money. You are okay, it is a sunk cost. Your profit or loss on the contract is 100 rupees because you are not exercising your right to buy and you are leaving it as such. The contract, you are letting it expire. So, from 1800 till 2100, your loss is minus 100. What is this minus 100? The initial premium that you have paid. Moment it crosses 2100 and reaches, let us say, 2200. You are like, suddenly you wake up. Let me buy from this fellow at 2100 and sell in the market at 2200 and make 100 rupees profit and recover my initial 100 rupees premium. What is my profit? My profit or loss is 0. So, initially the loss is like this. This is y-axis and this is x-axis, and y-axis, let us say you plot all the profits, and in x-axis you plot the stock prices 17, 18, 19, 20, 21, till 21 your profit is a negative number, minus 100. But moment it reaches 2200, the price reaches 2200, you are breaking even. Let us say the price reaches 2300. You will exercise your contract, buy it at 2100, sell it in the market at 2300, make 200 rupees profit, adjust with your 100 rupees of premium, you made net profit of 100. So, this line like this it comes, then it breaks even at 2200, then keeps on increasing. Right. So, buy call payoff, that is buy call profits look like this in a y-axis. This is in the y-axis if you plot the profit value, in x-axis you plot the stock prices. The option payoff chart looks like this. Okay. It is flat till one point, breaks even at some point and then moves up. And how long can it move up? So, Reliance share price from 2000, how much can it go? Theoretically, it can go to 1 lakh also, no? I am being very theoretical here, okay? It can go to as high. So, profits from an option are theoretically unlimited. What happens to loss? Your loss is only 100 rupees. Your loss is 100 rupees. As the price increases, your profits increase and they go up to infinity. And what have you done for all of this? You have invested only 100 rupees. 100 rupees premium, you can potentially make unlimited gains. That is why options are so attractive. That is why options are so attractive. They can be used as a risk-taking instrument. They can be used as a hedging instrument also. They can be used as both. They can be used as both, but they give you returns. Potentially unlimited returns with a floor on losses. See how exciting this sounds? What are we saying? Initial premium that you pay is limited. If it is a loss, it is loss. That 100 rupees is gone. But if there is a gain, the gain can be potentially unlimited. What an excellent contract. If Reliance share price goes up and I have purchased a call on Reliance, I will make gains. How much? As much as the Reliance share price goes after this 2200 number, because 2200 is the break even. Now exactly look ulta. Exactly look ulta. What do I mean by ulta? This is buyer of a call. Now let us look at seller of a call. We just discussed what happens to the seller. Whatever are the profits of one person or losses of another person. Exactly mirror images. So now in this graph what we have, the graph is like this for a buy call. What will it be for a seller of a call? Exactly mirror image. So it will be like this. What do you mean? Like this, what does it mean? It means when the price is 1800, 1900, 2000, 2100, the buyer of the call will not exercise. When the buyer does not exercise, the original premium that the seller has received stays with him. So his profit is 100. Profit is 100. When the price reaches 2200, profit becomes 0. Why? The seller has to buy from the market at 2200, sell to the buyer at 2100, make a loss of 100, but adjust it with the original premium he received of 100 and the profit or loss becomes 0. So, your buy call and sell call intersect at this point 2200. And what are the losses? The losses are unlimited. Why? If the stock price goes to 1 lakh. As a seller of the call, you are supposed to buy from market at 1 lakh and give it to this gentleman, whoever has purchased. In our case, you have purchased, right? You're supposed to give it, the seller of the call is supposed to give it to you at 2100 only. So, loss is 98,000 or 97,900, whatever it is. And the small chutku, some small adjustment of 100 rupees of original premium is received. That's all that you will adjust. But the loss is unlimited. So, in case of a buy call, this is how it goes. In case of a sell call, this is how it goes. Right, this is the payoff matrix. I will showcase to you this payoff matrix again in Excel, much more easily, much more live. Okay, I have tried to explain it in a visual perspective. I will now explain it in a pure mathematical perspective. Okay, we will do that. But before we do that, let us understand what happens in a put option. What is a put option? Let us take the same Reliance share example. Today the stock price of Reliance is 2000. You think that I want to buy a right to sell the shares. Why will you do that? You think that the share price of Reliance will go down. So you are thinking Reliance price will go down to 1900. So you are entering into a contract which is a put option. You have a right to sell the shares of Reliance which are today trading at 2000. You will say I have a right to sell the shares of Reliance at 1900 because you think that the share price will come down to 1900 or 1800, something, it will fall. So you say I want to enter into a contract where I can sell shares of Reliance at 1900 rupees 3 months later. Because I want that right, I am willing to pay you a premium of 100 rupees. It can be 100, it can be 50. We will come to the logic of arriving at that 100 or 50 later. Understand the simplistic example, then you can get into the depths of how that premium is arrived. Okay. I have a right to sell the share of Reliance at 1900 rupees 3 months later. Because I want the right to sell the share, I will pay you 100 rupees. Okay. So 100 rupees is the premium. Now, if share of Reliance, let us say, falls to 1500, share of Reliance falls to 1500 on the 90th day, what is going to happen? You will say, I have made a killing because I have a right to sell at 1900. Today the market price is 1500. I will buy from the market at 1500 and sell off to this fellow at 1900. Whoever has sold me this put option, that fellow is bound to buy from me at 1900. Whereas I can buy from the market at 15. So I will buy it market at 15, sell it to him at 1900. I have made 400 rupees profit. And of course, initial 100 rupees premium, whatever I have paid, I will adjust. So I have made 300 rupees profit. A put option gives the holder of the option, that is the buyer of the option, a right to sell the shares of Reliance at a future date at a predetermined price. It gives the buyer of the put option a right to sell the shares of Reliance, in our case Reliance, at a future date, because it is a European option, it is a fixed date, at a predetermined price of 1900, irrespective of what the price there is on market on that day. So let us say, instead of 1500, on that day, the market price is 3000. From 2000 rupees today, you enter into a contract for selling at 1900, market it is 3000. Will you want to sell it to somebody at 1900 when you can sell it in market at 3000? No, right? If you had shares of Reliance, you will say, I will sell it in market at 3000. But in this entire options that what you have to remember is, we are dealing with transactions of the underlying of Reliance Industries. Okay, in our example, Reliance Industries. Without owning the share, we may enter into contracts. That is called speculation. By owning the share, if you enter into a contract, it is basically some sort of risk management or hedging. For a moment, remove this hedging concept and think of purely speculation. You don't have shares of Reliance. You are agreeing to sell to somebody at 1900 rupees. In the market, it is at 3000. Will you enter into that contract or will you honor that contract or not? You will say, get lost. You will say, I don't want to do anything with this contract. I have paid initially 100 rupees. I have lost that 100 rupees. Forget it. But if the market price is 1500, you will say, no. I will sell it to him at 1900. I will buy from the market at 1500 and sell it off to him at 1900, and I will make 400 profit, adjust that 100 rupees of premium and make a 300 net profit. Whereas if the price goes up, I will ignore the contract. Why? Because I have a right to ignore. That is, I have a choice. I don't have an obligation. It is my right. It is my option. It is my choice of whether I wish to sell or not sell. In a put option, it is all about right to sell. In a call option, it is about right to buy. Right. So, what we saw here, in a put option, if the price goes down, the buyer of the put option makes money. When it went down from 2000 to 1500, he made money, 300 rupees. When the price goes up, the buyer of the option loses the initial premium because you will not honor the contract. So, if you were to draw a payoff chart or payoff scenario, payoff diagram, whatever you call it, okay, and you again were to draw a chart. Y-axis, you will put the profits. X-axis, you will put the price of the Reliance. What price is this? This is the price on the future date, not today's price. Today's price we already know. Exercise price we already know. It is 1900. Future price on 90th day, what is going to be the price? Let us say you put all the prices, 1700, 1800, 1900, 2000, 2100, so on and so forth. What did we discuss? If the price goes down, you make profit. How much profit do you make? What did we see? When the price went down, current price is 2000, but it went down to 1500. When it was at 1500, you made a profit of 300 rupees. How did we get 300? Because the contract is for 1900 rupees to sell shares of Reliance at 1900 rupees. Because the contract was to sell it at 1900 rupees, current market price is 1500. You basically directly made a profit of 400 rupees minus 100 rupees premium. So 300 is profit. So at a point of 1500, the profit is 300. If the price becomes 1000, what is the profit? You will add another 500 rupees. So 800 is the profit. If the price becomes 0, argument's sake, price becomes 0, what is the profit? Profit will be 1800 rupees. How 1800? You agreed to sell to him at 1900. Okay, you have a right to sell that. And you initially paid 100 rupees. Market mein price is 0. So even though it is a dud, useless, zero value stock, he has to buy from you at 1900. So you give the stock, take 1900 rupees and you adjust it with 100 rupees of premium what you paid, you make profit of 1800. So in the case of a put option, the profits are highest when the price is 0. Slowly they start falling. They become 0 when? They become 0 when the price is very close to your exercise price. Our exercise price is what here? 1900. So at 1800, you agreed to sell to him somebody at 1900 rupees. Even though market price is 1800, he has to buy from you at 1900. He will buy from you at 1900. You will buy from the market at 18, sell it to him at 19. You made 100 rupees profit. But then you had paid initial 100 rupees premium. So 100 knock off. So this profit becomes 0 at this price, 1800 rupees. How did we get 1800? It is actually the strike price, 1900 minus the premium that is paid. At that point, the put option basically gives a profit of 0. Before that, it keeps on going, but it is capped. It is capped. And then what happens to the loss? After it comes here, after it comes to 1800, let us say the price is now 1900. At 1900, will you exercise or not exercise? Market price also 1900, here also 1900 in this particular contract. So it doesn't make any difference. Even if you exercise, you're going to get it at 1900. If you don't exercise also, you get it at 1900. But initially, whatever 100 you paid is a loss. So the curve comes like this, and at this point, the loss is fixated at 100 rupees. So at every further price, at 2000, 2100, 2200, 2300, 2400, as the price keeps increasing, you will not exercise the contract and your loss is limited to the 100 rupees that you have paid. So look at the beauty of a put option. In a put option, if you believe that the price is going down and you buy a put option, you make money that is equivalent to the difference between your price on the closing date and the strike price that you have entered into minus the premium that you have paid. That is, here we said 1800 rupees is the profit when the price is 0. Correct? Slowly it falls and then your loss is limited to 100 rupees. So when the stock price moves higher, you make a flat loss, which is your premium that you have paid. Correct? Now, this is for the buyer of a put option. What is it for the seller of a put option? Seller of a put option also has very similar structure. What similar structure? Exactly mirror image. Like in case of a call option, the put option seller also has a mirror image profits or losses of the buyer. So the seller will have mirror image of the buyer. How does that work? This 100, whatever is the loss that you are making, is the loss you are making because you are not exercising. So whatever is the loss that you are making when the price goes up is the loss that you have made on account of premium. So it is the gain for that other party. So a writer of a put option, a writer means seller. An option seller is also called as a writer. A writer or a seller of a put option makes money when you are not exercising the option. And the money that they make is the premium. So this entire, mirror image of this comes here. So this is the premium. And he makes a loss, he or she. What is the loss that they make? If the price becomes 0, they have to buy from you because you have a right to sell. If the price becomes 0, you still are going to sell at 1900. So they make a loss of 1900 is the entire loss minus they adjust the 100 rupees premium. So they make a loss of 1800 here. We have understood this in a visual sense. We will go into pure, very simple. I will put all these numbers in an Excel sheet and draw the chart right in front of you. Okay, that will help us understand. This Excel sheet is also going to be provided to you. Very, very simple concept. See, the whole funda in call and put options, buying and selling, if you understand, no, if these 4 concepts you understand very well, believe me, everything else is far, far simpler. Everything else is simpler. In this particular chapter, you have to fundamentally understand these 4 concepts. Call, put, buy, sell. Call is right to buy, put is right to sell. You can buy a right to buy, you can sell a right to buy. Buy a right to sell a right to sell. It sounds slightly confusing, it is not. If you think logically, it is very, very simple. You can buy a right to buy, you can sell a right to buy. You can buy a right to sell, you can sell a right to sell. Okay. This is buy call, buy put, sell put. Very, very simple. You have understood this? See, the easiest way for you to remember these 4 concepts, right, is take 4 or 5 examples, randomly assume numbers and keep on drawing charts. Okay, draw this 5 or 6 charts, what I have told you or what I am going to give you in Excel, and you will easily understand. Believe me, this is the most crucial part of this entire concept of options. If you understood this, everything else will be simple. Okay, now let's go and draw these Excel charts or the payoff matrices in Excel live in front of you. Okay.